Good morning and welcome to Global Markets Daily Brief. I'm Jonathan Simkowitz, and today is Tuesday, February the 17th, 2026, the first trading day back after the President's Day holiday. And the real question this morning is not whether the AI trade is broken, because it isn't, but whether the market has finally started to price the difference between AI as a capital expenditure story and AI as a disruption story, because those are two very different things. And right now, Wall Street is struggling to hold both ideas in its head at the same time. So let's start with our first story, the fact that US markets are heading into genuinely uncharted territory. And what I mean by that is we came into Tuesday with the S&P 500 hovering right around its 100-day moving average near 6812, a level it hasn't closed below in 3 months. And within the first hour of trading, the index slid almost 1% as the so-called SaaSpocalypse trade. The fear that AI automation tools will eat software as a service businesses alive drag names like Oracle, Intuit, and Salesforce sharply lower, yet by midday, the index staged a remarkable reversal, erasing roughly $600 billion of losses in about 30 minutes and pushing back in the green, which tells you something important about positioning. There are real buyers underneath this market. The breadth is still healthy, with around 63% of S&P 500 stocks above their 50-day moving averages, and the equal weight index actually rose more than 1% on Friday. So what most people are missing is that this is not a broad market breakdown. It is a violent sector rotation where the mega-cap tech names that carried us here are being re-rated lower, while financials, utilities, and value stocks are quietly absorbing the flows. The risk is not that the market crashes. The risk is that the leadership change is happening faster than most portfolios are positioned for. And my base case is that we are in a mid-cycle rotation, not a late-cycle top. But the thing to watch is whether the 100-day moving average on the S&P holds on a closing basis this week. Because if it doesn't, the next support band is meaningfully lower and the narrative will shift from healthy rotation to something is wrong. Now let's turn to our second story, which is that big oil executives are under increasing pressure to articulate credible growth plans at a moment when the macro backdrop is actively working against them. After years of rewarding shareholders through buybacks and capital discipline, the energy majors are now being asked a harder question, which is, where does the next decade of production come from, and can you fund it without destroying the balance sheet? Chevron has laid out an organic capital expenditure budget in the range of $18 to $19 billion for 2026. Exxon and others are ramping Permian and Guyana output, and Canadian oil sands producers are forecasting higher volumes, even as Brent hovers in the low 60s. In the U.S. Energy Information Administration projects, it could average around $55 per barrel this year. So the market's first reaction has been to punish the energy sector, with the energy select sector SPDR falling about 1.8% last week. And what's not priced in my view, is the pivot toward natural gas and power generation, because several majors are quietly positioning to fund gas-fired power plants and even data center infrastructure, which would provide a steadier earnings stream than upstream oil. And if crude does dip below $50 at some point this year, as some forecasters expect, that will accelerate consolidation and force the laggards to either merge or slash spending, creating a binary setup for energy investors. Meanwhile, looking at the broader market snapshot, the Dow closed Friday around 49,500, the Nasdaq at roughly 22,547, and the S&P at 6836, with technology, financials, energy, and communication services all finishing the prior week in the red, while utilities gained about 1.5%. Psychologically, what this tells you is that the market is not panicking. It is hedging, rotating into defensive and yield-generating names while waiting for a catalyst. And the catalyst everyone is watching is NVIDIA's earnings on February the 25th. Because if NVIDIA delivers and the guidance holds, the AI hardware narrative stabilizes, and the rotation likely pauses. But if there is any wobble in the data center spending outlook, the SaaSpocalypse fear bleeds into the hardware names too, and we have a much broader problem.
Our third story takes us to China, where the annual Spring Festival migration, known as Chunyun, is underway and is on pace to generate a record 9.5 billion passenger trips over 40 days, up from 8.6 billion last year, a staggering number that most Western investors will glance at and move past, but shouldn't, because it is a real-time stress test of the Chinese consumer and the country's infrastructure build-out. China's high-speed rail network has now surpassed 50,000 kilometers, which is more than every other country on Earth combined. The state railway operator handled over 4.25 billion passenger trips in 2025 alone. And this year they've added 1,300 additional daily train services just to manage the holiday surge. What most people are missing is that this is not just a cultural story. It is an economic signal. The fact that travel volumes are setting records suggests the Chinese consumer is more mobile and more willing to spend than the dire consensus on China's economy would have you believe. And yet the market is largely ignoring it because as the headline narrative remains focused on property sector weakness and deflation fears. So the gap between the on-the-ground consumer data and the macro pessimism is worth watching closely, especially for anyone positioned short Chinese consumer and travel names. Now looking at the cross-asset picture, the 10-year Treasury yield dipped to fresh 2-month lows around 4% to 4.03% after Friday's softer than expected January CPI print, which came in at 2.4% year-over-year versus the 2.5% consensus. And that is supporting rate cut expectations. Markets are now pricing roughly 225 basis point cuts this year, likely in June and September, while gold pulled back from recent highs and is trading around $5,000 per ounce. WTI crude hovering near $63 per barrel, caught between geopolitical risk from the US-Iran standoff in the Strait of Hormuz and the fundamental reality of a well-supplied market, and the dollar is firming, which is adding pressure to commodities and emerging market assets. If I'm wrong about the mid-cycle rotation thesis, and this is actually something more ominous, it will look like the 10-year yield breaking decisively below 3.75% on a flight to safety bid, the VX, which is currently sitting around 21. Spiking above 30, and the equal weight S&P index rolling over alongside the cap-weighted index, because right now the divergence between those two is the single most important tell in the market. So let me bring it all together. We have a market that is rotating hard beneath the surface, with AI disruption fears hammering software and mega-cap tech, while value financials and defensive sectors quietly absorb the capital. We have big oil at an inflection point where executives must convince investors that growth plans are fundable even if crude slides further, and we have a Chinese consumer that appears stronger than the consensus believes, wrapped inside an infrastructure story that the West continues to underappreciate. My base case is that this rotation has further to run but does not morph into a bear market, provided Nvidia earnings hold the line and the Fed minutes tomorrow don't surprise hawkishly. The bull case is that softer inflation data pulls the Fed into cutting sooner than June. The 10-year yield drifts toward 3.75%, and that re-rates both growth and value higher in a broad-based rally. And the bear case is that AI disruption fears metastasize beyond software into hardware and services. The S&P loses its 100-day moving average on a closing basis, and the incoming Fed chair transition in May creates a policy vacuum that amplifies the uncertainty. This is market commentary, not financial advice. Always do your own work and consult a professional before making investment decisions. If you found this analysis useful, please subscribe to Global Markets Daily Brief wherever you get your puss. Leave a review, and I'll see you right back here tomorrow morning.